The Committee on Financial Services will come to order. Without objection, the chair is recognized to declare a recess of the committee at any time. Today's hearing is titled The Annual Report of the Financial Stability Oversight Council. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. I now recognize myself for a 4-minute opening statement. Good morning, Treasury Secretary Bessent. Welcome. It's an honor to have you with us today to provide testimony as the chair of the Financial Stability Oversight Council. Today, we will examine recent actions taken by the FSOC and provide members the opportunity to address any questions or concerns regarding FSOC's 2025 annual report. As the 2025 annual report makes clear, economic growth is essential for financial stability. In a growing economy with rising incomes, debt burdens fall, American standards of living rise, and the financial system remains stable. It's encouraging to have financial regulators and policymakers who understand this fundamental reality and aim to foster a regulatory environment that considers how both new and existing regulations alter and impact economic growth. Committee Republicans share the commitment to promoting economic growth through the elimination of unnecessary regulatory burdens, a hallmark of the Trump administration. Since assuming the presidency just over a year ago, President Trump has built on this critical work that he achieved in his first administration to make further progress in rolling back overly burdensome regulations that stifle innovation in our economic growth. These efforts go beyond reducing just regulatory red tape. They're about fostering an environment where financial institutions can thrive and contribute to the stability and growth of our economy. I'd be remiss if I didn't remind everyone in the room today of the doom and gloom economic predictions that we heard across the aisle as the Trump administration was sworn in. In late 2024, Moody's Analytics anticipated that a Republican-controlled government would bring 3.5% inflation, 5% unemployment, a recession, and a budget deficit of 6% of GDP. Since then, Democrats have repeatedly and wrongfully accused Republicans of, quote, tanking the economy, close quote. With most of the official data in the books, these warnings missed the mark by a mile. Inflation came in at nearly 1 percentage point lower than that forecast. The unemployment rate never increased beyond 4.5%. No recession materialized, and GDP is on track to have 3 consecutive quarters above 3% growth. Meanwhile, the budget deficit is on track to fall to some 5.4% of the GDP. These numbers speak for themselves. Under President Trump's leadership and Treasury Secretary Bessent's steady hand, the economy is back on track, reversing the damage of the previous administration. Throughout the 119th Congress and committee Republicans remain steadfast in our goal of reinvigorating the commercial banking system and make life more affordable for our American families. That commitment is why I introduced the Main Street Capital Access Act with Subcommittee of Financial Institutions Chair Andy Barr last month. Our community banking package is designed to revitalize local bank formation, right-size regulations that are intended for far larger and more complex institutions, ensure that community lenders can focus on serving our families, small businesses, and our local economies. This bill also aligns with the administration's efforts to right-size regulation and reflects the committee Republicans' dedication to ensuring that financial operations focus on safety and soundness with a tailored approach to supervisory complexity. Similarly, our bipartisan Housing for the 21st Century Act addresses housing affordability head-on by reducing the burdens that have made homes and apartment construction untenable. Improving affordability requires directly expanding the housing supply. Paired with Main Street Capital Access, Americans will benefit from more homes and more affordable ways to finance them. We're grateful for your time today, Mr. Secretary. We look forward to the discussion, and I yield back the balance of my time. I now recognize the ranking member of the committee, Mrs. Waters of California, for a 4-minute opening statement.
Thank you very much, Mr. Chairman. Last week, Donald Trump marked his first year in office with consumer confidence plummeting to a 12-year low. That is not a coincidence. Trump promised a so-called golden age, but apparently he only meant one for his family and billionaire friends. Instead of helping families, Trump's trade wars are driving up the price of goods like groceries, clothing, and furniture. Small businesses and farmers feel it too, and we all know exactly who is to blame. Instead of lowering costs, Donald Trump has doubled down on chaos and cruelty while handing more power and more freedom to Wall Street. For example, instead of directing the Financial Stability Oversight Council to address threats to our economy, Mr. Secretary, it appears that using it to do the exact opposite and deregulate Wall Street. While Trump claimed he wants to cap credit card interest rates, his administration has repealed rules that curbed excessive credit card late fees and shuttered the Consumer Financial Protection Bureau, the very agency that returned $21 billion to Americans after they were ripped off. In fact, Trump's team has dismissed enforcement actions against predatory firms, even after they admitted to defrauding consumers. Why? Could it be because they gave to Trump's campaign or brought his crypto coins? Or could it be this president is not on the side of the American consumer and never has been? It does not stop there. Right now, Trump's Justice Department is conducting a baseless criminal investigation into Jerome Powell to bully the Federal Reserve so they serve Trump's agenda instead of the American people. Since Trump returned to office, Republicans have looked the other way while consumer protections were gutted. Instead of offering solutions to help families, they have protected corporate profits. Under this administration, billionaires are winning and hardworking Americans are losing. We've seen this movie before. The same blind loyalty and deregulation led directly to the 2008 financial crisis when millions of Americans lost their jobs, their homes, and their savings, all while Wall Street walked away with bonuses. Despite repeated demands from Democrats for accountability, Republicans have refused to bring other key administration officials before Congress. That includes CFPB Acting Director Russell Vought, who must be held accountable for dismantling the CFPB. This includes FHA Director and Bill Pulte, who has unlawfully installed himself and his staff on the board of Fannie and Freddie, weaponized mortgage data to try to attack Trump's political enemies, and who is incompetently pushing just plain dumb housing policies like a 50-year mortgage. Every turn, committee, Democrats, and I are standing up for America's consumers, defending strong safeguards, fighting corporate abuse, and the corruption of the Trump family. It's just common sense. Our economy should work for everyone, not just for Trump, that billionaire circles that he's involved with. Republicans need to stand up to Trump, defend our regulators, protect consumers, and put families ahead of Wall Street. Anything less is complicity.
The gentlewoman's time has expired.
I yield back.
I recognize the chair of our Subcommittee on Financial Institutions, Mr. Barr of Kentucky, for a 1-minute opening statement.
Thank you, Mr. Chairman. Secretary Bessent, welcome back to the committee. Under your leadership, FSOC has done a terrific job eliminating unnecessary regulatory burdens and promote economic growth. Common sense legislation like the Main Street Capital Access Act is exactly the type of pro-growth proposal to promote financial stability that FSOC highlighted in its annual report. I'm proud to sponsor the TIER Act and the Community Bank Regulatory Tailoring Act that will modernize outdated statutory thresholds that impose disproportionate regulatory burdens on our financial system. This committee, along with FSOC, can successfully support our community lenders and allow them to thrive under right-sized regulation with this legislation in place. Regulatory tailoring helps to protect the diversity of our financial system, which is itself key to promoting financial stability. I look forward to working with the Treasury Department as you implement my outbound investment legislation that the President signed into law in December. With you at the reins, FSOC has returned to its core values and away from the weaponization and disarray we experienced under the Biden administration. I yield back.
Gentleman yields back. I recognize the ranking member of our Subcommittee of Financial Institutions, Dr. Bill Foster of Illinois, for a 1-minute opening statement.
Thank you, Chair Hill. Mark Twain is credited with observing that history does not repeat but often rhymes, and those of us who served on this committee during the financial crisis recognize this poem and its tragic ending. We have once again a historically unpopular president, fixated on the glory of his overseas misadventures and foreign bailouts. We have once again a multi-trillion-dollar asset bubble underpinned by opaque and conflicted financial mechanisms that nobody understands by design, being willfully ignored by partisan financial deregulators. And we have families all over America who, despite all the happy talk from the president, are having a hard time paying their mortgages and their monthly bills. You can hardly open any financial news source without seeing a discussion of the pending collapse of the AI circular investment bubble. And that is why we created the FSOC. And that is why last November, Democrats on this committee sent you a letter as chair of FSOC to figure out what we'll have to do when the music stops. Your response was insufficient, dismissive, and dangerous to our economy. I look forward to hearing more from our questions and yield back.
Gentleman yields back. Today we welcome the testimony of the Honorable Scott Bessent, Secretary of the Department of Treasury and Chair of the Financial Stability Oversight Council. Secretary Bessent, we thank you for taking time to join us today. We'll be recognized for 5 minutes to give an oral presentation of your written testimony, and without objection, your written statement will be made part of the record. Mr. Secretary, you're recognized for 5 minutes.
Chairman Hill, Ranking Member Waters, and members of the committee, thank you for inviting me to discuss the Financial Stability Oversight Council's 2025 annual report. This report is a culmination of extensive collaboration amongst FSOC members. I'd like to thank them for their hard work and dedication in advancing the President's bold vision for a better America. Since day one, President Trump has focused on building parallel prosperity, an era of economic expansion where Wall Street and Main Street can grow together. To that end, Treasury has tirelessly pursued pro-growth policies to unlock the potential available to all Americans when they are free to save, invest, build businesses, and drive their own economic destinies. The Financial Stability Oversight Council plays an important role in delivering on this agenda. Too often in the past, we've seen regulation by reflex. Rather than preempting crises, regulators have frequently reacted to them after the fact. They played the role of a hazmat cleanup team instead of preventing dangerous spillovers in the first place. Regulation by reflex has led to a regulatory myopia that has undermined safety and soundness. Under President Biden, the bank regulators preoccupied themselves with reputation risk, climate-related financial risk, and other risks with no clear nexus to safety and soundness. At the same time, they centered supervision on management and other governance matters that distracted examiners and banks' risk managers from the real risk to safety and soundness. The result, predictably, was the second, third, and fourth largest bank failures in U.S. history in 2023. Besides undermining safety and soundness, regulation by reflex has driven excessive regulation. That can lead to economic stagnation, and economic stagnation is itself a grave threat to financial stability. In calibrating regulations, federal agencies must avoid the temptation to create a zero-risk financial system, which would result in what others have called the stability of the graveyard. FSOC should aim to identify vulnerabilities that could lead to systemic crises and encourage the private sector to mitigate those risks before recommending additional regulation. FSOC should also work with its members to support efforts to avoid or pare back existing regulation that stifles pro-growth lending, capital formation, and innovation. And the best way to achieve these goals is by centering economic growth and economic security at the heart of FSOC's agenda. Promoting economic growth and economic security is essential to ensuring financial stability. Economic growth strengthens household, business, and financial institution balance sheets, creating capital buffers that reduce the risk of defaults and financial stress. And economic security reinforces domestic production capacity, raising living standards while reducing vulnerability to external shocks and supply chain disruptions. FSOC's annual report prioritizes economic growth and economic security accordingly, with a specific focus on 4 policy areas: treasury markets, cybersecurity, regulatory modernization, and AI. First, the Council is ensuring that the U.S. Treasury market remains the deepest and most liquid in the world. The Council is supporting efforts by member agencies to strengthen this market against future shocks, including through the Interagency Working Group on Treasury Market Surveillance and the Market Resilience Working Group. Ongoing monitoring and targeted reforms by individual agencies remain essential to financial stability. Second, the Council is taking action to protect our financial system from increasingly sophisticated cyber attacks. Nation-state actors and criminal groups continue to target our financial institutions and infrastructure. To address this risk, the Council is supporting expanded information sharing, joint monitoring, and scenario-based exercises, and it is emphasizing the need for regulated firms to manage cyber risks tied to third-party service providers. Third, the Council is committed to supporting efforts to modernize supervisory and regulatory frameworks for banks and credit unions. Going forward, regulation and supervision should address material risk, enhance transparency, and reduce unnecessary burdens, particularly for small and community banks. Fourth, the Council is prioritizing the responsible use of artificial intelligence to strengthen financial stability. The Council is working with public and private partners, including international counterparts, to enhance system resilience while closely monitoring emerging risks. I will close by highlighting our progress in enhancing the utility of our annual report. In this year's report, FSOC shifted away from its past approach, where nearly every major market and financial sector was described as a financial stability vulnerability. By introducing a new structure centered on fostering economic growth and security, we're tuning out the noise to concentrate on the issues that matter most for U.S. financial stability. With this overview, I look forward to taking your questions.
We'll now thank the Secretary, and we will turn to member questions, and I recognize myself for 5 minutes for questions. You made a persuasive case that since President Trump was sworn in, that economic growth is a cornerstone of his presidency, and you highlighted today, as you have in speeches over the year, the importance of that Wall Street's doing well, but it's Main Street's turn, and you'd like to see economic growth expanded into what I always quote from Steve Case, the rise of the rest, where we see that economic performance expand across the country. We share that commitment here on this committee by reversing elements of the regulatory framework that have sought, possibly certainly well-intentioned, the concept of too big to fail, but ended up in creating an environment over the past 15 years where community banks are too small to succeed, or maybe avoiding your term today you chose to use, the stability of the graveyard. The committee has worked together on a bipartisan basis to highlight some of the principal actions that we've considered over the past year. Our Main Street Capital Access Act, which we intend to bring to the House floor. We're grateful for your Undersecretary, Mr. McKernan, who last month joined us as we rolled out that package to talk about how we can collaborate. Would you take a minute and from your perspective, how do strong, well-capitalized community banks and the benefits of tailoring that are in this legislative proposal help accomplish faster economic growth and the rise of the rest?
Chairman Hill, as I've said, it's Main Street's turn, and essential for Main Street's having its turn are the small and community banks. And I would note that thanks to onerous regulation, and as you and I both say, community and small banks became too small to succeed. Tragically, more than 50% of our community banks have disappeared since the great financial crisis, not during, since. There have been virtually no de novo banks created, whereas before the GFC, there were more than 50 per year. And small and community banks not only are the anchor for community-based lending, but they provide the bulk of the lending for agriculture, for small real estate loans, and for small business loans. So a thriving community bank infrastructure and ecosystem is essential. I've met with more individually and in roundtables with more than 200 community bankers. I've spoken at conferences with more than 1,000, and tailoring is essential. I had one banker from my home state in South Carolina with assets of about $200 million tell me that under the previous regulatory regime, she was told that she should be more like Bank America, the second largest bank in the country. And so it is essential that we have the right tailoring, right risk levels, and right monitoring of these important institutions.
We thank you for your perspective on that, and to illustrate it in our work we've done on housing in the committee, also on a bipartisan basis, it was noted that banks under $10 billion in size, really the heart of our community banking system, several thousand banks across the country, they make 60% of our 1 to 4 family construction loans. And while banks of all sizes deliver amazing capital access in our economy, at the heart of our main streets, if we want more housing supply, we find that it's really that local